Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, you are in for one huge episode. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Glad to hear that I'm in for a huge episode.
Yes.
Today we're joined by Christopher Joye. He's the founder and portfolio manager at Coolabah Capital, a fixed interest investing house that manages over $11 billion for clients. He's one of the biggest and most well-known fixed interest managers in Australia.
Yeah.
He's certainly one of the most outspoken fixed interest managers in Australia.
Big time.
And for a part of the market that maybe is seen as a little bit more boring, a little bit slower going, a little bit more passive, Chris and the team of Coolabah certainly bring in active tilt to their fixed interest investing.
Big time. I love chatting to Chris. He always has, I guess, a keen interest on what is going on around the world from a macro point of view. So we'll be chatting to him a lot about that. I remember speaking to him the last time we spoke to him. He'd just got off the phone trading $100 billion in bonds on the phone in London overnight. So it's always,
I think 100 million, not 100 billion.
Was it 100 million?
He only has 11 billion under management.
True. 100 million. Whatever, Chris. I've just given you 10 times. But it's always a great chat. He has I guess a lot of insight, and his team are full of PhDs and the like. And I always get a lot out of these interviews. Yeah.
So today we're going to really cover off three big topics. We're going to start with the investing philosophy and how Coolabah approach the fixed interest markets. Then we're going to talk about the state of the market more generally. And Chris has been known for some big predictions over the past few years, particularly around Australian and US inflation and interest rates. They've been saying that they think there might be a second hiking cycle coming for Australia. So that will be something to listen out for. He thought the RBA would actually be humiliated into a second hiking cycle. So we'll chat about that. And then we're going to close out by talking about the hottest asset class in Australia at the moment, and that is private credit. Yeah. Because Chris is worried about private credit, I think is fair to say.
As we talk about the state of the market with Chris, you'll obviously hear that he's got some pretty opinionated and strong views, and whilst you might not agree with all of them, we think it's important to engage with as many views as possible.
Yeah.
So
I'm just looking through our video notes from this interview. At one point, he says that Victoria is basically a failed state. So look, you're going to hear some hot opinions. Yeah. But that's what we love about Chris, that he doesn't pull his punches, that he shares his views, and particularly his views when they're controversial. And to be fair to Chris, he's been right a fair bit. So look, with that said, let's get to this interview with Chris.
Well, Chris, welcome.
Thank you for having me, boys.
We want to start with your investment philosophy. A lot of fixed interest investors will kind of move out in duration in search of higher yields. That's not really how you do things at Coolabah. So can you just talk us through high level how you approach it?
Yeah, so at Coolabah, we are very active, and we're looking for mispriced bonds that are paying too much interest for their risk. So, a CBA bond paying 5.1% that our 80 different bond pricing models say should only pay 5%. And when we get that little compression in interest, we earn a capital gain, so price appreciation. And then that adds up every day. We trade about $1 billion a day. Our win ratios are circa 80 to 90%, so we're winning or making money 80 to 90% of the time. It's a very consistent process, but it requires a lot of people. So I have currently 52 staff, 11 traders, 19 analysts, spread between Sydney, Melbourne, Auckland, Miami and London. So it's a very quantitative process. We have 80 bond pricing models in total, and it requires a lot of activity. So we trade with more than 80 counterparties globally, but we would be one of the most active traders in the world. We're today running 15 billion. So when I was last year in, if memory serves, July 2020, so we probably had about 3 billion then.
Wow.
And we run 44 portfolios, 29 institutional mandates. We do run a bunch of ETFs. So Australia's biggest active ETF, HBRD for beta shares. which is a great product, has outperformed hybrid since it was launched, but also outperformed subordinated bonds, and that's actively managed. We've recently launched a geared bank bond product, YLDX, which is paying a yield of about 7.5% on A+ rated major bank bonds. And then we add the trading return on top of that. So over the last year or so, the unlisted product that is based on, that's called floating rate high yield, has returned about 9% after fees. So the difference between the yield and the total return is our trading alpha, our value add. Pre-fees, that would have done north of 10. So again, the difference between circa 7.5 and 10 is finding those mispriced bonds and getting those little capital gains that are compounding up. The typical mispricing we find is 5 to 10 basis points, and that generates a capital gain of about 0.25 to 0.5%. Now, you guys are equity mates. You're stock jockeys.
Index boys.
You love your punting, your 15% per annum equity volatility, the 60% drawdown in 2008, or the 20 to 30% drawdown in March 2020. But we're just simple, straightforward bond guys, and we run strategies that have volatility of typically between 1, 2, 3% per annum. But those mispricings, just by pulling out 10 basis points of mispricing, that'll give us a capital gain normally of about 0.5%. And you might say, oh, Joy boy, I don't get out of bed for 0.5% capital gains. Get out of here. However, if our typical holding period is measured in days, if you get 0.5% every few days, then that compounds up to a large number. In some of our strategies, our trading can generate annual returns, north of 20, 30%. Now, of course, we can't put all $15 billion into those 20 to 30% returning trades because that's just not possible. So the delivered return has to reflect the fact that we're not trading all the book all the time, but it's definitely how, in those ETFs, in the floating rate high yield fund and in the new YLDX ETF, our total returns have been strong. In our long short credit fund, which is a big product, about $1.5 billion, I think off the top of my head, has done about 9.6% after fees over the last 12 months. But these are in A+ rated bonds. So CBA, ANZ, NAB, Westpac bonds with daily liquidity, and we also hedge out all interest rate risk and FX risk. So we're running floating rate strategies. So they tend to be lower volatility. Some of our strategies can use gearing, others do not. But the philosophy, in summary, is all about finding mispricings in the very inefficient unlisted bond market. I think the best explanation of that inefficiency is really this, that if I buy and sell $1 billion of stocks like you guys do, everyone in the world sees the prices immediately and instantaneously. So you're competing against every algo, every AI, every machine on the planet. And the market's supremely efficient. And the equity guys are generally smarter than the debt guys, for sure, because they're paid better fees. If you go to an equity fund manager, he's going to have a performance fee, he's going to have a 1-2% management fee, he's going to be heinously expensive, and they tend to hire the smartest guys in the room. In fixed income land, the fees are paltry, typically no performance fees, typically much lower management fees. So the fixed income managers tend to be much more static, much more hold to maturity. They don't actively trade. They don't have the technology, the intellectual and analytical wherewithal to price these securities actively. But it is something that we at Coolabah do. So we do tend to run high margin portfolios. We have the biggest team in Australian fixed income. We're definitely the most active trader of Aussie bonds globally, and one of the most active traders in the world. But when we buy and sell $1 billion of Aussie bonds, the price and volume are never reported anywhere, ever. There's more transparency in the housing market.
Wow.
No, I'm not joking. You buy a house, 3 months later, the data goes to the Land Titles Office. You can log on to CoreLogic or RP data, and you can pull up the price. In the bond market, it's just a black hole. And that creates tremendous inefficiency. And also because the participants are like ETFs often in the bond market, or very passive fund managers, there are lots of pricing discrepancies. And so that's what Coolabah does. We're hunting for those mispricings on an unrelenting basis, 24/6, trading US bonds, Euro bonds, Sterling bonds, New Zealand bonds, Aussie bonds, all global bonds, corporate bonds, bank bonds, government bonds, trying to generate the best possible total returns. The other thing we really focus on is super liquid bonds that don't have default risks. And this is an important point. There's 7,000 bond issuers globally. in the corporate and bank space, but we only invest with 289. Now, the 289 are like the mega caps in the bond market. They actually account for 53% of all bonds outstanding. So that circa 300 cohort of companies, namely banks, insurers, and corporates, those 300 entities account for more than half of all bonds outstanding. But we are kicking out the 6,700 that are the kind of the tail, the dodgy, default-ridden, illiquid credits that exist out there. So examples that some of your listeners might remember, Virgin Airlines. We all used to fly on Virgin Airlines. They issued a bond on the ASX paying almost 8%. All of our peers loaded up on it. Great, 8% yield, Virgin Airlines. We wouldn't touch it with a 40-foot cattle prod. And that's because it was unprofitable and highly levered. And we were like, in any downturn, Virgin's going to go bust. Sure enough, the pandemic hits, Virgin goes bust, and the bonds were worthless and hammered Aussie portfolios. Another example that hit Australians was Credit Suisse. A lot of Aussies held Credit Suisse hybrids, or a lot of our peers held Credit Suisse hybrids. They were paying like 10% yields. They looked really attractive in 2022. But our analysts, our 19 analysts came to us in May 2021, actually at the start of 2021, and they said, listen, we don't want you to have any exposure to Credit Suisse. We're worried it could go bust. I actually wrote to Australia's richest man, one of the richest men in the country, Andrew Forrest, the founder of Fortescue, and he had shifted $1 billion into the Credit Suisse private bank at the start of 2021. I wrote to him 5 times. In fact, he's offsider, the deputy chair of Fortescue. I won't say his name, but I wrote to him 5 times and I said, listen, you got to really get Twiggy's money out of Credit Suisse. And that was in 21. We started shorting their bonds in 22, so we were betting on the bond prices going down, and they blew up and disappeared, and the hybrids were worthless. They were zeroed, 100% loss in March 23.
Wow.
So we're focused on super high grade, super liquid, bonds that don't have default risk, that are very, very tradable, and we're trying to use our intellectual edge to make every basis point count, to find these small mispricings, just to get the precision around, should CBA pay us, like right now, we've probably bid a couple of $100 million into a NAB bond. It's live. It's pricing at 86 over, which is 0.86 percentage points over the bank bill rate, which is a proxy for the cash rate. Cash rate's about 4.1%. Bank bills will be around that. So you're getting about 5%. But we have fair value for this security as of yesterday at about 79 basis points over, right? So if they're paying us 86, we're getting about 7 basis points of extra interest. Now, the banks being the greedy buggers they are, they won't want to pay us 86, so I'm just trying to log into my Bloomberg terminal live so we can see this. So right now...
Bloomberg on the iPhone.
Update for... where are the greedy little... bastards pricing this thing? So 83 basis points. There you go. So they.
Oh, so it's come in a bit.
Yeah, it's coming from 86 to 83. We have fair value at 79, and I'll say what is our bid size. I think, but I'm guessing we would have bid for 1 or 200 million, maybe a little bit more, maybe 200 or 300 million.
So on that, like, it's one thing to recognize a mispricing, but when you're thinking in days, it's another thing to recognize a mispricing that will close. So, like, how do you think about the catalyst there?
Mate, that's a profound question. So for us, it's all about the speed of the mispricing closing or normalizing or mean reverting. So that's paramount. And so we use a lot of technology to basically forecast how fast the mispricing will close. And obviously, there's no point buying a bond that's cheap that's never going to normalise. And if we don't see the bond normalise or perform quickly, we normally exit that position very, very rapidly. So we're quite ruthless in that respect. But typically, I would say they start normalising within a few hours.
Oh, right.
So if the bond doesn't start performing within a few hours, we could get very focused on that position.
Wow.
Do you look at your fixed income peers and think about how little they do compared to how much you do? Or do you ever get jealous of that?
I remember interviewing this portfolio manager in New Zealand, and I said, so we have an 8 a.m. call, a 1 p.m. call, a 5:45 p.m. call, but within the day we're speaking, the data scientists are speaking to the portfolio managers hundreds of times a day, and there would be thousands of chats a day. And I remember interviewing this candidate. I said, so how often do you guys get together as a team and talk about the portfolio? And she said, oh, once a month.
Yeah.
And I'm like, we're talking hundreds of times a day.
Yeah.
And every Thursday night we have the Hunger Games competition, which is 3 randomly selected members of the team have to pitch their best investment idea.
Wow.
They get 10 minutes. There has to be a PowerPoint presentation. There's a $100 prize, and I don't score it. The team scores it, so there's a panel of people. So that's like they go to war every Thursday for the best ideas. And then on every Friday, we have the global risk call where every member of the team has to talk about something they're worried about.
Oh, that's good.
So from the most junior guy to the most senior guy. And then once a month we have the red teaming session. And in the red teaming session we get 3 randomly selected teams, and they have to attack a part of the portfolio or a part of the business. So we try and foster as much critical discussion and debate as possible. We are paid more in fees than your average bond manager. But we could turn over our funds as much as 25 times a year.
Yeah, wow.
Whereas a typical active bond fund manager might turn it over 0.3 to 0.5 times a year.
Wow.
You're turning it over more than equity managers are turning it over.
Oh, yeah. Like we'd be doing 50 to 100 times more than what a normal bond manager would do. So at the end of the day, you pay peanuts, you get monkeys. Yeah. But it's not of course, I don't want to cast any aspersions against my peers. I hold them in the utmost respect. And, they're beta, we're alpha. I mean, that's fine. Albeit I guess you could get much cheaper beta if you bought an ETF. And the other thing that to understand, this confuses a lot of people. You sometimes hear the sort of aphorism, bond markets are smarter than equity markets. I don't know if you guys ever heard that.
Yeah, we've certainly heard it. Yeah.
The equity junkies both crossing their arms, looking very defensive, very apprehensive, a bit insecure. But so I would say, so that's kind of right and wrong. Okay. So there's 2 parts of the bond market. There is the physical bond market where you buy and sell $1 billion a day. The prices and volumes are never disclosed anywhere. It's very hold to maturity. It's very passive. It's very sleepy. It's like trading shares before stock markets existed in the mid-20th century. Literally, you ring up Goldman Sachs and selling to UBS. So it's over-the-counter, unlisted bilateral. It's like trading homes. In fact, that's probably the best analogy. Like buying and selling bonds is like buying and selling houses, with the benefit of not disclosing any pricing at all. But there's another part of the bond market which is called the interest rate derivative market, and there the interest rate futures contracts trade on exchanges. And that is like a listed version of the bond market, but it's really a derivative market or a futures market that trades around expectations for future interest rate moves, not for moves on credit spreads or corporate bond spreads, but rather for moves around the RBA. Where will the RBA cash rate be in 12 months, 3 years, 5 years, 10 years, and so on. And likewise for the US Federal Reserve. Now, those markets are exchange traded. They're fully digitized. They are completely transparent. They are totally lit. And every freaking mofo AI and CTA and machine out there is hunting mispricings in those markets, and they are incredibly competitive. The irony is, so those markets are the smart bond markets. So what I would say is, in summary, the interest rate futures market, very smart. And you want to always treat it with the utmost respect. Formidable adversary. But we only hedge in that market. We don't try and generally second guess that market. The physical bond market, on the other hand, is replete with these really deep inefficiencies.
Will it ever?
And that's where the dumb money is.
Will it ever become transparent, do you think, or there's just no desire for?
It's been rigged that way because the banks make money not from brokerage or commission, but from the difference between the buy, sell, and the sell spread.
Yeah. Okay.
So if I buy a bond off you at $100 and I sell to you at 102, you're going to say, that's a great deal, Chris, because you weren't aware, you're oblivious to the fact that I actually only paid $100 for the bond. And Goldman earns 2%, the $2, right? Whereas if I sell to you at 102 and you see I bought it at 100 immediately because the price was disclosed, you're going to say, hey, mofo, I'm never paying 102 again. I'm going to pay 100.1 next time.
Yeah.
And you're going to earn bugger all. So the banks have globally rigged the market to be as opaque as possible to maximise bid offer spreads.
Yeah.
Bloody banks.
Which is not great for everyone, but good for you because it allows you to keep that intellectual edge in the space.
Exactly.
Yeah. So we want to turn to the state of the market. I think everyone's become an armchair expert in interest rates and inflation over the past few years, but you and the team are actually experts. So how do you assess the current state, I guess, of the macro environment here in Australia, but globally as well?
Let's start globally. Late last year, actually, if we begin from the start of last year, in January 24, the bond market was saying we're going to get 175 basis points of cuts from the Fed, and we only got 100. And we'd argued all that year that the cuts would really disappoint and be a lot less than the market thought. The market said, and this is actually the smart part of the bond market, it said the Fed would start cutting in March. We said it would be the back end of the year. They started in September. We argued the Fed was being political, trying to help Biden and Harris win the election. And sure enough, as soon as Trump won, instantaneously the Fed got hawkish. And they had one last reluctant cut in December, and now all bets are off. We argued last year that you get a re-acceleration of US inflation. That's exactly what we've seen. and that's being driven by higher goods prices. And obviously the tariffs that are being introduced by Trump and the spectre of a trade war. And we think in the US that the tariffs are really a very serious proposition. So the smart money was arguing that Trump's a preternatural deal maker. He's going to bluff his way through these tariffs. He's just negotiating. This is just the art of the deal. And we said that's horseshit. We said, no, he needs the tariffs for these reasons. The most important thing to Trump is the tax cuts. And they cost him $8.1 trillion US over 10 years. If he doesn't fund the tax cuts, there'll be a debt crisis in the US. Interest rates will go through the roof because bond bandits like me will say, hey, I'm not going to buy $8 trillion of US treasuries unless you pay me much higher rates. So the tariffs are actually needed to raise revenue to pay for the tax cuts. Based on the tariffs he's announced, 25% on Canada, Mexico, 10% on China. There were already 15% tariffs on China, so that puts them to 25. On our numbers, that will raise 1.8 trillion US.
Over 10 years?
Over 10 years.
Yeah.
So there's this huge gap. You got this 6.2 trillion or $6.3 trillion gap. And on those numbers, the US budget deficit each year that they're running will jump from 5.75% of GDP to 7.75% of GDP. That's the flow. That's the annual difference between revenue and expenses for the US government. But then, in addition to that, the stock of debt will explode because those deficits have to be funded each year, and he has to issue debt or borrow money from people like me. So the explosion in the stock of debt is from about 98% of GDP in terms of the value of US government bonds relative to GDP to 133% on our numbers. And that, all things being equal, should push up long-term interest rates. And we did see, we argued last year when the US 10-year government bond yield, which is like the price of money globally, as in it's kind of the benchmark for everything, when that hit 3.6%, we said that it's going to push past 4.5 again. And sure enough, it hit 4.8 this year. It's come back a bit. It's been in the lower fours recently. But that's a problem for equities pricing. And we've argued for 1 to 2 years that equities are massively overvalued. And obviously, thus far, we've been wrong. But it's sobering, just as an aside, to remember, and I'm sure given you guys are equity polymaths, you'd be familiar with the data. But can you tell me, boys, when was the last time the S&P 500 punched out annual returns of 20% plus in succession? Do you remember?
It wasn't too long ago.
Throw out a year.
Like the last 2 years?
Well,
No,
this
before
was,
that. Before
I'm proud of that.
I feel
was
like we did this.
I mean, I'd hazard a guess it's
I'm
going to
like-
be like an 06 and 07 or a...
06, 07?
Yeah.
I'd be
Okay,
going
it's
similar.
probably before you guys were born. It was in 1998 and 1999.
Oh, okay. Yeah.
Yeah. Were you guys alive then or not?
We were, yeah.
How old were you?
Just. It would have been 7.
Yeah.
Yeah,
so-
okay.
yeah.
Oh, you get a free pass on that one. But do you remember, you're a little bit older, do you remember what happened to US equities in the 2 years after?
Yeah, got
Yeah,
smashed.
yeah.
.com bubble, 9/11.
Yeah.
Yeah, lost decade for the US.
Yeah, so basically US equities in 2000, 2001 fell about 20% and the intra-year loss was 36%. So the problem with equities is, as you know as well as anyone, cyclically adjusted PEs have been at close to all-time highs, and there's no margin for error in equity pricing. And so higher interest rates are very bad for equity valuations. But coming back to the macro, the first point is Trump needs the tariffs to pay for the tax cuts. And even with the tariffs, he only gets 1.8 trillion over 10 years. And so debt to GDP goes from 98% to 133%. That's why he needs Elon Musk as well. But the tariffs he's dead serious about. The other point about the tariffs is, his view, I think rightly, is China basically stole through state-funded market share gains US manufacturing over a period of about 30 years. So supply chains shifted to the Chinese, and the idea was that US companies could outsource to China, so everything could be made in China and it'd be much more cost effective. But actually, the reason they were willing to do that and trade with China was the presumption was that China would move towards a democratic model. It had created all this wealth through trading with the West, so it would become like the West. But President Xi had a very different idea, and he was like, no, I just want power and control, so I'm going to continue to subsidize all my companies so that they have an artificial cost advantage. It's like BYD versus Tesla. I'm going to steal everyone's IP like Tesla. So Tesla sets up factories in China. The Chinese steal the IP, set up BYD, and now BYD is murking Tesla in global product markets. And at some point, it took 30 years, but the penny dropped in the US. And they're like, you know what? Fuck this. We're not going to try and negotiate deals with China. We don't want to trade with China, period. They are a completely untrustworthy counterparty. So the strategy in the US is to block China from Western markets so that you need tariffs to do that. So he's very serious about the tariffs. It still creates this huge debt binge because he's short 6.2 to 3 trillion over 10 years. And the panacea, therefore, is Elon Musk. This is why all roads lead to Musk, because Musk is saying, I can cut government spending by 15%. Ostensibly actually seems very achievable, because like if anyone who's run a small business would know, reducing your cost base by 15% is not that hard. And in an environment like the US where you've had massive government wastage for like decades, that should be superficially straightforward. That will cut the annual deficit by $1 trillion. The annual deficit is 1.9 trillion. So over 10 years, that's 10 trillion in savings. So if Musk can stay the course, if his partnership with Trump endures, if he continues to keep the imprimatur of Trump, then I think he'll be successful. And that could be an environment where basically you're going to get a big increase in unemployment, or a reasonable increase in unemployment. You're going to get a big reduction in demand because all this government spending is going to disappear. You're going to get a reduction in growth. That reduced growth will be disinflationary, and that could encourage the Fed to cut rates. So that's a positive outcome. Now, the flip side is that in the meantime, until we kind of arrive in that interesting state where governments are shrinking, demand's shrinking, unemployment's rising, and the Fed's cutting rates, right here and now the Fed's saying, hey, there's a tariff war, inflation expectations have spiked in the US, the highest level since
90s.
1996, yes, smarter than you guys look. And so the Fed's on hold, and at the same time, corporates are now starting to worry about, like, if there's $1 trillion of spending coming out of the US budget, that's going to hit corporate earnings. And if there's less demand, that's going to hit corporate earnings. And if the unemployment's going to increase, that's going to hit corporate earnings. So equities, which were trading at crazy levels, have started to capitulate. So we saw overnight almost 3% drawdown intraday. The E-mini, which is the S&P 500 futures contract, had been trading down 1% at one point, although it bounced. Let's just see if it's given up. It's now flat. So you've had a pretty big drawdown in equities just recently. S&P 500, trading below, I think, 5,600 points. Poor old Bitcoin.
Yes.
Yeah, under
sub 80.
Yeah, it was up around 109, but right now, unfortunately for the Bitcoin junkies, is trading around 79,000.
Time to get in, Chris.
79,381.
Get in.
Problem is, my friends were telling me that at 100, 90, 85, 80. I was with a very important client prior to this meeting, which is why I was 15 minutes late. But he said, well, what's your outlook? I just think you're going to get a lot of volatility, a lot of turbulence, because we're adjusting to a very, very new regime. And I think in the short term, it'll probably be the straw that breaks the camel's back in terms of equity pricing. But I think in the medium term, there's lots of opportunity to be positive, because you're going to get a huge reinvestment in US manufacturing. So tons of investment, spending, massive improvements in productivity. I think the US can now compete in manufacturing because a lot of it will be robotic and automated, and less reliant on human capital and labour costs, where obviously they're uncompetitive vis-a-vis, Vietnam and China and Mexico. And then you've got this geopolitical overlay, which is obviously a bit of a volatility amplification machine, and then the kind of never-ending Trump tape bombs. You wake up.
I know.
There's a new drama every day.
I know. Yeah.
Have you guys cut all your equity risk?
No. We're
You're
very
balls deep.
exposed. Bryce is leveraged long.
You're levered long. Equities.
Just a little bit.
Jesus.
That's why we're interviewing you, Chris. We need to see the other side.
We don't have to report our performance every year. Yeah.
40 years ahead.
So call out to advertisers for equity mates. Bryce is under the pump. He was levered long US equity futures, and he's just basically torched most of his net worth.
Yeah. That's how we're going to keep doing the podcast.
It's fine.
You said US debt could get up to 133% of GDP. You sort of hear from some people that a country that prints its own currency and prices debt in its own currency can't have a debt crisis. Do you think that's the case with the US?
Yeah, so I think there's a bit of confusion around what we mean by a debt crisis. I mean like a big increase in long-term interest rates that would create a lot of market turbulence, big dislocations, a big shock. I don't think the US is going to default on its debt in any way, shape or form. I don't think that's a risk at all. So when I say debt crisis, I just mean a big recalibration of the long-term cost of capital in the US. We didn't talk about what it means for Australia. Australia's a bit different. In Australia, the RBA started cutting rates. We argued late last year we didn't think they should cut rates, but we thought they would. So we thought on the one hand they shouldn't, but we argued they would in December last year.
Well, can I just interrupt you there? Because we wanted to ask you about Australia, and you actually said that the RBA would be quote unquote humiliated into a second hiking cycle, which I like. So
yeah, what date was that?
About halfway through last year, I think.
Yeah, so this is consistent with what I was saying earlier, the re-acceleration of global inflation thesis. So about that time, Chalmers introduced these cost of living subsidies. So Jim Chalmers, the Treasurer, introduced these cost of living subsidies that have artificially suppressed the Aussie inflation data. We don't think they should cut, but we think they've been politically compromised. Most of the RBA board has been appointed by Chalmers now. He appointed the governor and the deputy governor. And they've been the most dovish central bank in the world. Most central banks went to 5.5%. Canada, the UK, US, New Zealand, we only went to 4.35. And the RBA's own models implied that they should have gone to 5. So there weren't any particularly good reasons for the RBA to keep rates as low as they did. And I mean, this latest rate cut in February is ridiculous because they've come out and cut rates and then kind of desperately pleaded to everybody that, hey, no more cuts are coming. So it's kind of begs the question, well, why did you cut rates in the first place? Because one cut doesn't do anything.
It's housing, isn't it? That's why they didn't go as high and that's why they cut there. It's like none of these
you never cut rates just once. It's only 25 basis points. It doesn't change the price of eggs in China.
No, but it did change the sentiment in the housing market if you believe it.
Yeah, I argue that. So there's a little bit of nuance around this. So we just come back to the RBA, first principles. We think there'll be a re-acceleration in Aussie inflation as well. We think the Aussie economy is about a year behind the US economy. So we actually do think that the RBA could be humiliated by a second hiking cycle. But in the meantime, they've kind of punched out this weak-willed, yellow-bellied little cut. And I've never seen them do this before. Like, they would never normally cut just once. I don't think that's ever happened. They would always cut by a minimum 2 to 3 times. Wow. So to cut once and then say that, quote unquote, the market's totally unrealistic to expect another 2 to 3 cuts is bizarre in the extreme. The other thing that was bizarre about the cut was they actually lowered their estimate of the normal or neutral interest rate in Australia, which they'd previously handicapped at about a 3.5% cash rate. Now, they were at 4.35, they're now at 4.1. They handicapped that they cut their estimate of neutral from 3.5 to 3. Now, all things being equal, that would imply that they would need much deeper cuts because it suggests that policy has been much more restrictive or tougher than what they'd previously assumed. But when they cut rates, they actually dissed their own publication and their own research that pointed to this lower neutral rate and said, oh, no, nothing's really changed, even though we've dropped our neutral rate by 50 basis points. So coming to your point, I argued at the time they cut rates, which we correctly forecast in December, that it would be actually really meaningful. So on the one hand, it's not meaningful, but I think it is meaningful in terms of the zeitgeist. And I've been pointing to the housing data consistently in my financial review columns. So you have seen Sydney house prices have gone from falling to they've definitely started to increase again. And we're seeing the same thing in Melbourne. Just on this one cut. And I think it's around the atmospherics that we're no longer worried about hikes. We've had our first cut. The bond market's saying we're going to get 2 to 3 more cuts this year. So we're going to get more interest rate relief. And let's go hammer and tongs. And we're definitely seeing much more activity in the housing market. So the Aussie economy is in this really interesting situation. We've run the strongest population growth in the world, right? So we're running 2 to 3% population growth. And that's bringing a huge amount of people and money into the country, and that is like a net demand shock.
Right.
So I think Australia's got, on the one hand, that population-fueled growth. On the other hand, we've got a ton of government spending. The federal budget has just lurched into deficit. The states are spending crazy amounts of money. Like Victoria in 2019 owed about 50 to 60 billion to the rest of the world. Now they owe almost 300 billion to the rest of the world. Victoria is basically a failed state, and unfortunately. I went to school in Victoria, so my commiserations for my former schoolmates. But so you got huge public spending. In fact, 82% of all jobs growth last year was driven by the public sector rather than private sector. And Australia's becoming a very heavily regulated and heavily taxed country, which is really stifling entrepreneurship and innovation. That public spending is creating a lot of inflation. And when the cost of living subsidies are due to expire halfway through this year, when they expire, the inflation data will mechanically pop back up. So I think the jury's out on whether the RBA can cut rates, and there is definitely a risk of a second hiking cycle. And I think the same is true in the US. I think Bank of America actually came out and said that they thought the next move in the Fed's rate would be up, not down. So all of this is on the table.
Yeah, although you got Donald Trump quoted in a recent interview saying no one got rich when interest rates were high, so he obviously wants to put some pressure on for rates to go lower.
Yeah, they're focusing on the 10-year government bond yield, and it has come down since he's come to power. Listen, if they go really hard on slashing government spending, that yield will come down. And if they close the budget deficit, which would be amazing, it will be disinflationary.
The question is just what can they do? Like Medicare, Social Security, Medicaid is 75% of the budget. Then you've got interest payments, and then you've got defence spending. To cut 15% of the budget, you have to basically cut all discretionary spending.
Yeah, so I think my own view on this is there's tons of waste in areas like defence where they can radically reduce spending without impacting capability. And I actually think it's you've got to put everything on the table.
Yeah, if defence is on the table, then...
Yeah, it's like NDIS here in Australia. I mean, the amount of wastage I think that we're spending like 50 to 60 billion a year on the NDIS, which didn't exist only a few years ago. So if you want to rationalise that program, you could probably cut it in half. So I definitely think there's ample scope to rationalise government spending, and I think 15% is actually really easy to achieve, but you've got to have it all on the table.
Yeah. Well, Chris, we wanted to kind of close out by addressing the rise of private credit, because it's been one of the hottest asset classes of the past sort of couple of years. What do you think about it? Like, what's your view on what has kind of transpired over the last sort of 2 to 3 years?
Well, I think it's important to understand that, we went through this period where the PIMCOs of the world were saying we were living in a low rates for long environment. Interest rates were going to stay around 0% forever. That was, the period between 2008 and 2021. Now, we argued the opposite. We said that there would be an inflation shock eventually and that rates would go a lot higher. But a lot of people built business models on the presumption that rates would remain low for long. And that's really what spawned the advent of private debt. Private credit didn't exist in Australia before 2008. It really didn't exist. What happened in the subprime crisis in 2008 is, banks blew up, regulators came along and said, hey, you got all these taxpayer bailouts, fellas, banks. You have to stop lending to people who can't repay their loans. And so the banks are like, no problem. We'll be much more prudent and responsible, less reckless. But those reckless borrowers still wanted to get finance. And then the private credit shops all started opening up saying, we can lend to these borrowers, get great interest rates, and you don't need to worry about default risk. It's like subprime before the subprime crisis. It's all too good to be true. And none of these borrowers could survive a high rate climate. And that's now, unfortunately, what we're facing, a high rate climate. So I've been arguing for years that private credit will be a disaster. In late 2021, I wrote relentlessly in the AFR in early 22 that this interest rate hiking cycle would give us the mother of all bankruptcy cycles. Bankruptcies in Australia are the highest ever recorded. In the US, UK, and New Zealand, they're the highest since 2008. And every day you open up the Financial Review, you're reading, like today, about another private credit fund that's frozen, as in it's freezing redemptions. A quarter of the fund is in distress. The loans that were meant to be debt are having to be forced into equity. You're reading about private credit guys that have lent to all these resi developers that have blown up, and suddenly the private credit guys are now turning or morphing themselves into resi developers. But it kind of makes you wonder, if these resi developers who have been around for decades and are notionally good at what they do can't make things work, how can a private credit guy who has no resi development experience at all suddenly kind of pull the rabbit out of their hat? It's an absolute disaster, private debt. Everywhere you look, all these funds, 10 to 20% of their loans are all in default or they're being restructured. You're not reading necessarily, they're not reporting defaults because they extend and pretend. The guy that's about to default tomorrow, they say, okay, the loan that's due tomorrow will extend another 12 months or will capitalise the interest. A lot of these loans have capitalising interest. you're reading about funds that are like 25, 30% equity now because they've done debt for equity swaps. So again, debt managers are suddenly having to become expert equity managers. And I think it's very, very challenging. There's no liquidity. Investors assumed that there would be liquidity, but funds are now freezing and they can't get their money out because the assets themselves are inherently illiquid. So I think it's all blowing up. I think it's going to get a lot worse, particularly if the RBA doesn't cut rates. Heaven forbid if we have a period where they're on hold or hike again. And I think it's just going to be a multi-year pain trade.
Yeah, wow. Okay.
Jeez. So
Pain trade.
for advisors listening who are, seeing these private credit funds come across their desk and, their clients are asking them about it, like how do you suggest advisors should talk to their clients about this asset class?
Well, I mean, one of the best things to do is look what happened to the private credit funds that were listed on the ASX in March 2020. So that is really sobering because you see what daily pricing does to these funds. And, there were a bunch of them, Partners Group, KKR, Perpetual, that Qualitas that had these listed debt funds, LITs, listed investment trusts that hold debt. And in 2019, I wrote regularly in the AFR, I think in any stress event, these things are going to trade at big discounts to their net asset value or net tangible assets, NTA. And everyone excoriated me for doing this. They said, "Oh, Joy boy, conflicted, blah, blah, blah. You're just jealous." Well, sure enough, a few months later, in March 2020 hit, and they all traded at 40 to 60% discounts to NTA, and most were forced to privatise. But we are seeing, with the demise of the hybrid market, so the banking regulators come out and said, we're going to phase out bank hybrids by 2032. And there's 43 billion of bank hybrids out there. And investors are worried about where they're going to put that money once those hybrids mature. And we've had ANZ and CBA maturities which will occur in March and April. And so we're now seeing a tsunami of these new debt LITs again. They're all private credit funds kind of put in an exchange wrapper, a listed investment trust. And my concern is we're going to see, the equity market's capitulating, but I would not be surprised if we saw them trading at big discounts to NTA again on the ASX when people start getting the yips and start rushing for the exits. So I think, if you take a stress event where these things could be marked down 20, 30, 40% plus, for an advisor listening, I'd say to the client, you just got to explain that. Like, with these private credit funds, you can have all your funds locked up. They can be completely illiquid. 10 to 20% of the entire portfolio could be in default. You could end up holding 30% of the portfolio in illiquid equity. And if this thing was listed, if you use March 2020 as a guide, it could trade at a 40 to 60% discount to NTA. So I just think you have to be very, very careful. And I think people have underestimated the value of the liquidity in a lot of liquid assets. Our funds are all daily liquidity. And that provides tremendous optionality because when you want to take your money from the relatively lower volatility, say, fixed income fund, and pounce into equities because equities are down 30%, you can do that. But when you locked up all that cash in a private credit fund, you have no optionality.
So, Chris, one question to close it out. There's been a lot of, negative sentiment in this conversation, like the risk in private credit, the problems in the Australian economy, challenges in the US. Give us one reason for hope. Give us one thing that you look at across all your metrics from all your analysts and you think that is a light on the horizon.
Yeah, the one thing I'm very hopeful around, which is a universal constant, is just the power of entrepreneurship and innovation in the United States. I think the US is going through this cathartic revolution. We swung way too far to the left. We had the emergence of what people have rightly or wrongly described as Wokistan, and populated by Wokahontases. And I just think that government was strangling and suffocating business, and that process of asphyxiating idea generation, freedom of expression, entrepreneurship, and innovation was a huge problem in terms of generating productivity, prosperity, growth, demand, activity. And you're seeing it in the US in the form of, I think, business now has a new lease of life. And so I think that revolution in the US, if it were to, I'm not confident it will be emulated across the rest of the world because I think different countries are at different parts of the cycle. I think the US has had many crises that have precipitated this existential moment intellectually. You've had this internal battle between Republican and Democratic business models. So people look at California, basically a failed state, San Francisco, a failed city, compared to Texas and Florida, which are thriving, running budget surpluses. The standard of living is massive. You've got huge positive population growth into those states. Businesses are thriving. And I think they want change. They recognise that, yes, we need governments to provide safety nets, but we ultimately want markets to be the arbiter of the winners and losers, not governments cherry-picking winners and losers. So I think the Trumpian revolution is a really constructive one. I think the other thing that's constructive is having Elon Musk, who's a fairly, notwithstanding people like to vilify Musk, he has been arguably the most important entrepreneur of the last couple of centuries. He's changed the course of human history. And to have him in a fairly unconflicted way offer all of his intellectual horsepower and capability to help solve some of the most intractable economic problems in the US, I think is incredibly powerful. So combining Trump and Musk together, I think that partnership could endure quite a long time. A lot of people have said the capricious and mercurial Trump won't allow him to sort of survive in that regime. But the reality is Trump likes winners. He wants to back winners, and the biggest winner in human history is Elon Musk. And I don't think he's a threat to Trump insofar as he can be a foil for Trump. He can do a lot of the heavy hitting that Trump might not be able to have executed himself. And I think he also presents many intellectual solutions to Trump's policy problems. You've got this massive budget deficit. I mean, there are a few people in the world that could go in there and just lay waste to vast swathes of the US public sector. But he's willing to do that. And, he's suffering financially. Tesla's share price has been, hammered. I assume there will be potential consequences for SpaceX. Starlink. Yeah, his personal security is really at risk. He said on the Joe Rogan podcast recently, and I'd been saying the same thing for weeks, that his biggest fear is he'll actually be knocked off. Because, if you're taking $1 trillion a year out of other people's pockets.
Firing tens of thousands.
Especially if they start putting defence spending on the table.
That's what they've done. Defence is in the crosshairs. It won't take long for someone to say, hey, let's just get rid of this guy. And in the US, that's not an uncommon thing. So, Trump's had his ear blown off. So I think the positive is we are at a key inflection point in history, economically, geopolitically. There's a new business model that's being developed, which is actually a hark back to the past, a more laissez-faire approach where you can allow the market to survive and thrive. I think also geopolitically the positive here is we're getting a fundamental restructuring of the power relations between major states. So I think what's happening is, on the one hand, Trump is saying the rest of the world has been free riding off our 3.5% of GDP. Like, we're the biggest economy in the world, and we've been spending 3.5% of that economy on purely providing protection for the rest of the world. But the rest of the world, rather than picking up their fair share, has only been spending 1.5%. And been free riding because of that moral hazard, because they've got this insurer of last resort in the form of the US hegemon, and they'd rather spend money on social welfare like they have in Europe. So Trump said, enough is enough. I'm going to pull that security blanket away, and you're going to have to fend for yourselves. And if I'm going to give money to someone like Ukraine, well, I want something in return, in the same way that the Europeans structured their supporters' loans. Biden did it. He structured his supporters' gifts. So now Trump wants to strike a deal with the Ukraine that's much fairer for the US people. And I think a lot of that makes sense. I think with Russia, he's trying to drive a wedge between Russia and China, which I actually think is a smart trade. And I think that he can negotiate with Putin and structure a new relationship with Russia, which will avoid this axis of evil emerging between Russia, China, North Korea, and Iran. On Iran, I mean, they're very close now, if not on the precipice of being able to produce weapons-grade uranium that can be used for nuclear weapons. So Iran needs to be dealt with promptly. I think the Israelis want to sort of strike irreversible blows against Iran's nuclear programs in Natanz and other sites. And I can see a situation where with the implicit or perhaps explicit support of the US, Israel takes out Iran's nuclear facilities. Iran's really isolated right now because Hezbollah's gone, Hamas is basically gone, Syria has gone. So some of the traditional Iranian allies have been eviscerated in the Middle East. Saudi Arabia's got this new nascent relationship emerging with Israel. Iran's really only friend is Russia. So if Trump can drive a wedge between Russia and Iran and Russia and China, I think the world becomes a safer place. And if the Israelis can take out and fundamentally retard the Iranian nuclear capabilities, I think, again, the world is a safer place. So these are big sort of tectonic shifts, but they're important ones. But I think in the medium term, there are hope for a lot of prosperity. The other thing I'd say is the rebuilding of the US manufacturing base is going to catalyze massive investment in the US. You're seeing it with TSMC committing to $100 billion US of investment in semiconductor fabs in the US, which is key. So I'm very positive about the US economy. I wouldn't be levered to the hilt like Bryce is, but I think there's an opportunity after this drawdown. I think you'll probably get a decent correction in equity valuations, and there'll be an opportunity to dive back in, perhaps with some modest leverage at some future state of nature.
Love it, Chris. Well, fascinating point to end on. You've left us with a lot to think about. We appreciate you coming on and sharing it all with us today. So thank you so much.
Thanks, buddy.
Thanks,
guys.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.